Hello there. In this session, we are going to look at how to account for long-term assets, particularly plant, property and equipment, also known as PPE, and also later we are going to look at intangible assets. We're going to start by looking at the different types of long-term assets, okay? And then we're going to look at what happens during the acquisition and maintenance of plant, property and equipment. We're also going to look at the journal entries during this acquisition or maintenance process, okay? And then we are going to learn about the different depreciation methods that are used for plant, property and equipment. The three methods we'll be focusing on are straight line method, units of production method, and the third method, which is an accelerated depreciation method known as the declining balance method. Further, we'll be looking at how to deal with impairment and disposal of plant, property and equipment. Finally, we'll be looking at how to account for natural resources and intangible assets. We'll start by classifying long-term assets into tangible assets and intangible assets. Tangible assets are assets which have any kind of form or physical substance, okay, such as land, equipment or natural resources, right? Anything you can touch and feel is tangible. On the other hand, intangible assets are assets which do not have any physical substance, okay, such as goodwill or patents or franchises, etc. First, we'll start with what happens when a firm acquires an asset. Okay, when a firm acquires a PPE or plant, property and equipment, from here on, we're going to just refer to it as PPE. The acquisition cost of the asset is calculated as the sum of the purchase price and all other expenses until the asset is ready to use. Okay, expenses such as shipping, installation costs or taxes, okay, all these can be considered expenses until the asset is ready to use. Okay, when you purchase an asset, what is the journal entry you would do? Okay, assuming that you're paying with cash to buy this asset, okay, you would debit your PPE account, okay, which increases your asset, okay, and you would credit your cash account, which decreases your assets, so it stays balanced. So this is the journal entry you would make when the asset is being purchased. Later in this session, we'll look at depreciation to see what kind of journal entries you would make in the following time periods, okay. Once the asset has been acquired, you can still spend on maintenance in the following time periods. What you spend on maintenance can be something major that improves the lifetime of that asset or something that is minor like repair work that is just necessary to keep functioning. These major expenses are typically capitalized while the minor expenses are expensed. Okay, let's look into detail at what this means. Okay, what type of expenses are capitalized? Expenses that provide benefit beyond the current life period. Okay, may improve efficiency and extend its useful life. Okay, and it also occurs infrequently. If you do any kind of upgrade work, okay, it occurs infrequently and it involves large amounts of money. When you make such major investments, okay, these expenses are typically reported on the balance sheet as an asset, okay, and then they are depreciated in future time periods. It's almost like you just bought a new asset. Upgrading an asset to improve its lifespan is treated like you almost bought a new asset. On the other side, what kind of maintenance work is expensed? Okay, any minor work like repairs or normal maintenance is expensed. These expenses do not improve the productivity or efficiency or extend the lifetime beyond the original estimated usage of that asset. Okay, they're also recurring in nature. Usually, small amounts of expenses are typically expensed right away. Okay, these expenses are reported on the income statement in the current period. So you don't capitalize them as an asset, but rather you expense them straight away in the income statement. Later in this session, we'll be looking into depreciation in detail, which is basically capitalizing an asset and then expensing it in the future periods. So understanding depreciation will help you go a long way in distinguishing what capitalizing and what expensing is. So how do you make the journal entries in either of these cases? When you capitalize any kind of maintenance work, you treat it like an asset. Okay, if you're paying cash, you would credit cash, okay, but you would debit your PPE account. So this kind of emphasizes that this investment is made on that asset to improve the quality of the asset and the lifetime of the asset. Then what does the journal entry look like when you typically expense any kind of repair work? Okay, if you're paying with cash, then you would credit cash again, but you would debit your expense account, okay, which brings down your stockholders' equity. So instead of capitalizing it and expensing in the future time periods, you're already going to expense it in the current time period. Now, as a firm starts using its long-term assets, these assets start depreciating in value. Okay, so for example, tangible assets like machines depreciate in value the more you use them. Except land, all other tangible assets are expected to lose their value the more and more you use them, right? Regarding intangible assets of limited life, such as patents, okay, these patents are worth less and less with passage of time, right? Okay, so these intangible assets have to be amortized. The same goes with natural resources. These resources get depleted with time. The more you mine a mineral from its field, okay, you are depleting that field of that mineral, right? Hence, the field loses its value over time. From an accounting perspective, these three terms can be used interchangeably. In a typical financial statement, you're more likely to encounter the term depreciation because depreciation can be solely used to represent all these terms put together. Now let's try to visualize what depreciation is from an accounting perspective. Okay, let's assume that a certain asset has been purchased right now, okay, for a price of $4,000, and this asset has a lifetime of 4 years. When you see the cash flow statement, you can see there is a cash outflow of $4,000 right now and no further cash flows in the remaining time periods. Okay, so what we've done here is we've capitalized this asset which is worth $4,000 at the time of purchase. But because this asset has a lifetime of 4 years and it helps to generate revenue over these 4 years, it makes sense to somehow expense this purchase of the asset over the period of 4 years. So if this $4,000 was shown as an expense for that particular time period, even though it is being used for 4 time periods, okay, then in that particular time period, you would be overstating your expenses and hence you would be understating your profits. It would somehow make sense if you were able to split this $4,000 over the period of 4 years, maybe even equally, right? Okay. So in a way, through depreciation, what we do is we capitalize this asset worth $4,000 and then we depreciate this asset by $1,000 every year. And this $1,000 is removed from the assets and it's transferred to the income statement as an expense. So if we look at the journal entry for every year where we are depreciating the asset by $1,000, okay, we would have to debit an expense account. Okay, and we're going to call this a depreciation expense. Okay, this expense account is being debited by that $1,000. And we would also have to reduce the value of this asset. Okay, the asset which was valued at $4,000 when it was purchased. Okay, we would have to reduce the value of this asset by $1,000 every year. So instead of crediting this $1,000 directly from the PPE account, what we're going to do is we're going to create a contra asset account. Okay, we're going to call this accumulated depreciation. In this account, as the name suggests, okay, we're going to use this to accumulate the depreciation for our PPE. So what exactly is a contra asset? A contra asset is something that sits under assets, okay, but it decreases the value of assets. In this case, accumulated depreciation is a contra asset which sits along with PPE, okay, but it's used to reduce the value of our PPE. So if the asset had been originally bought for $4,000, so with an accumulated depreciation of $1,000 at the end of the first year, together the net value of our PPE is $4,000 minus $1,000, which is $3,000. Okay, so the book value of our asset at the end of the first year is $3,000. Okay, and then at the end of the second year, it would be $2,000. Okay, and so on. And finally, at the end of 4 years, okay, the net value of the asset would be 0. So you would be repeating this at the end of each year for a period of 4 years. What we've seen so far is an example of a method called straight line depreciation, okay, where we have a constant depreciation every year. Other methods of depreciation that can be used are units of production method. In this method, you would depreciate an asset based on how much it has been used. Another method of depreciation that's available and that can be used is the declining balance method. Okay, this method is an accelerated depreciation method, and we can use this whenever we would like to depreciate an asset much quicker in the earlier years of its lifetime. In reality though, most firms typically just use the straight line method because it's really simple to be followed. We'll look at the math behind each of these methods and then we'll look into them into a bit more detail using an example. How do we calculate the depreciation expense every year using the straight line method? Okay, you subtract the residual value of the asset, okay, from the cost at which it was purchased. And then you divide this by the usage life in years. Okay, in our previous example, okay, the cost was $4,000. The residual value was 0 at the end of 4 years. Okay, so 4,000 minus 0, okay, divided by 4 years of useful life. So 4,000 by 4 is $1,000 per year. Okay, so that's the depreciation expense per year using the straight line method. In the units of production method, the asset is depreciated based on how much it has been used. So in this method, first you calculate the depreciation rate. Okay, that helps you estimate how much the asset has depreciated for every unit that has been produced. So if you're a company that manufactures pens, okay, the depreciation rate would give you the depreciation of the machine that produces the pens for every pen that has been produced. Or if the asset is a car, then the depreciation rate would be the depreciation of the value of the car for every kilometer or mile that it has been driven. So once you've estimated the depreciation rate, you can use it to calculate the depreciation expense every year. Depending on how many units were produced each year, the depreciation expense is going to vary from year to year. In the third and final method, known as the declining balance method, okay, depreciation expense for each time period is calculated by multiplying the net book value of the asset at the beginning of that particular time period, okay, with a factor called N, and then dividing it by usage life in years. N is a factor that is used in this declining balance method. Okay, it represents the declining balance rate. So for example, if we'd like to use the double declining balance method, then N would take a value of 2 to denote that we would like to accelerate our depreciation with a factor of 2. Or in other words, we would like to depreciate our asset twice as fast. Also, how do you calculate the net book value of the asset at the beginning of each time period? You take the cost of the asset, okay, which refers to the price at which it was purchased. Okay, from the cost, you subtract all the depreciation that has been accumulated so far. Just looking at these expressions may seem a bit vague, okay, but we're using an example. We'll try to calculate the depreciation expense using these three methods, and then it gets a lot clearer. Okay, so let's jump into an example. Okay, at the beginning of the year, Joe purchased tech equipment for $5,000. Okay, the equipment has an estimated useful life of 4 years and an estimated residual value of $200. Okay, so at the end of 4 years, it has a residual value to be estimated at $200. The estimated useful life can also be classified in terms of number of hours of usage as 1,000 hours. Joe ended up using the equipment for 300 hours in year 1, 250 hours in year 2, 400 hours in the third year, okay, and 150 hours in year 4. Calculate the depreciation expense each year using the straight line, units of production, and double declining balance methods. Okay, let's look at the straight line method first. Okay, the first step would be to calculate the depreciation expense every year. Okay, so the cost of the tech equipment which was purchased is $5,000. Okay, minus the residual value at the end of 4 years. Okay, the residual or salvage value at the end of 4 years is $200. Okay, so 5,000 minus 200 is $4,800. $4,800 represent the value that has been lost by purchasing and using this equipment over a period of 4 years. Okay, so when you divide that by 4 years, you get a depreciation expense of $1,200. Okay, so $1,200 represents the depreciation every year for a period of 4 years using the straight line method. We can create a table like the one shown below here to understand depreciation a lot better. So when the equipment was purchased, okay, it had a value of $5,000. Okay, so at the beginning, it was worth $5,000. In year 1, the depreciation expense was $1,200. Okay, so the total accumulated depreciation is also $1,200. Now the book value at the end of year 1 is $3,800, which is 5,000 minus $1,200, which is $3,800. In year 2, the tech equipment undergoes further depreciation expense of $1,200. Okay, now the accumulated depreciation is $2,400 because $1,200 for year 1 and a further $1,200 for year 2. Now the book value of the equipment at the end of year 2 is 5,000 minus 2,400. So the equipment is worth only $2,600 as per our books at the end of year 2. Hence the phrase net book value, right? Okay, because the value of $2,600 is as per our books. So at this moment, at the end of year 2, if you looked at Joe's financial statements, okay, it would show that he has equipment, okay, which is worth $2,600 at this point in time. We can continue further. Year 3 also has a depreciation expense of $1,200 because we are still with the straight line method. Okay, so the accumulated depreciation is year 1, 2 and 3 put together, which is $3,600. Okay, now the net book value is $2,600 minus $1,200, which is $1,400. In the final year or year 4, okay, there is a further depreciation expense of $1,200, okay, which takes the overall accumulated depreciation to $4,800. Okay, this leaves us with a book value of $200 at the end of year 4. It's by design that we've reached the residual or salvage value of this particular equipment, right? We had initially used this $200 in the calculation of depreciation expense, which resulted in $1,200 per year. So it's not really a coincidence that we ended up with $200 as the book value at the end of 4 years. Next, we move on to the units of production method. Okay, in this method, first we have to calculate the depreciation expense per unit that is produced. Or in our case, the depreciation expense is calculated per hour of estimated usage of this particular equipment. Okay, again, the cost of the equipment is $5,000. The residual or salvage value is $200. Okay, the estimated usage life is 1,000 hours. So if you subtract 200 from 5,000, that's $4,800. Okay, divided by 1,000 hours, that gives us a depreciation of $4.8 per hour of usage. So this is the rate of depreciation per hour. Okay, now if we create a table like in the previous case, okay, we'll have to use the actual hours of usage that were provided to you in the question, right? Okay, the actual hours of usage were 300 hours in year 1 and 250 hours in year 2, for example. Okay, this is going to be used in the table now. Okay, so in the first year, the equipment was used for 300 hours. Okay, every hour of usage depreciates the equipment by $4.8. So 4.8 multiplied by 300 hours gives us $1,440. Okay, so that's the depreciation in year 1. Okay, that leaves us with a net book value of $3,560 at the end of year 1. In year 2, the equipment was used for 250 hours. Okay, so the depreciation for 250 hours multiplied by 4.8 is $1,200. Okay, so the total accumulated depreciation so far for year 1 and 2 together is $2,640, which leaves us with a net book value of $2,360 at the end of year 2. Okay, now at year 3, the equipment was used for 400 hours. So 400 times 4.8, okay, so the depreciation for that particular year is 1,920. Okay, so the accumulated depreciation so far is 4,560, which leaves us with a net book value at the end of year 3 for $440. If we continue for year 4, okay, the equipment was used for 150 hours. 150 multiplied by 4.8 is 720. Okay, if we use the depreciation expense of 720 here, okay, the net book value at the beginning of year 4 was $440. Okay, so a depreciation expense of $720 wouldn't make sense. In fact, we would have to end up with a net book value at the end of year 4 for exactly $200 because that was the estimated residual or salvage value at the beginning. So the correct amount of depreciation expense that would end up leading to a residual value of $200 is $240. Okay, so if we use the depreciation of $240 for year 4, okay, that brings the overall accumulated depreciation to $4,800 and a residual value of $200. Hence, wherever it's necessary, whenever you're using these different depreciation methods, you might have to make some adjustments to match the residual value that had been estimated. Moving on to the double declining balance method. In this method, we'll start by calculating the depreciation expense for year 1. Okay, so the net book value at the beginning of year 1 is the cost at which it was purchased. Okay, so $5,000 multiplied by n, okay, because this is the double declining balance method, n is equal to 2, divided by the total useful life in years. Okay, so 5,000 times 2 divided by 4. Okay, so the depreciation for year 1 is $2,500. So this results in a net book value at the end of year 1 as 5,000 minus 2,500, okay, which is $2,500 again. Now, how do we calculate the depreciation expense for year 2? Okay, we take the net book value at the end of year 1 or at the beginning of year 2. So this $2,500 will also be the book value at the beginning of year 2. Okay, we take that and again we multiply by the factor of 2 divided by 4. Okay, this gives us $1,250. So this is the depreciation for year 2. Okay, so the accumulated depreciation for 2 years is year 1 plus year 2, that is $3,750. Okay, so the net book value now at the end of year 2 is only $1,250. We repeat this process again to calculate the depreciation for year 3. Okay, so $1,250 multiplied by 2 divided by 4, that's $625. Okay, so that's the depreciation for year 3. So that leads us to an accumulated depreciation of 4,375, okay, which leaves a net book value of only $625 at the end of year 3. Finally, for year 4, to calculate the depreciation expense, okay, 625 multiplied by 2 divided by 4. So that's $312.5. If we use $312.5 as our depreciation expense, we wouldn't end up with a residual value of 200 at the end of year 4. Okay, so like in the previous case with the units of production method, okay, we'll again make an adjustment. Okay, how do you calculate this adjustment? You find out the depreciation expense that will lead to a residual value of 200 at the end of 4 years. Okay, in this case, a depreciation of 425 in year 4 would lead to a total accumulated depreciation of 4,800, and hence it would lead to a residual value of $200 at the end of year 4. So in this double declining balance depreciation method, you can see that the depreciation expense is going down with time. Hence, this is a type of accelerated depreciation, okay, because we are depreciating a lot of the asset's value in the first few years of its life. Now let's look at a side-by-side comparison between the straight line method and the declining balance depreciation method. I plotted the depreciation expense for each year using the two methods. Okay. In the straight line method, you can see that it's $1,200 every year, whereas in the double declining balance method, the depreciation expense has been steadily going down with time. Now let's consider the financial statement implications of choosing either method. If you were to choose the double declining balance method here, okay, you would show a higher expense earlier on in the life of the asset. A higher expense leads to lower pre-tax profits, okay, which results in lower taxes to be paid in that earlier period. But that also means you would report lower profits. But if you're a manager whose incentives are tied to firm performance, lower profits aren't exactly the ideal situation for you. On the other hand, if you're the owners of the firm, you would ideally prefer to pay lower taxes earlier on and accumulate more and more taxes to be paid later. So it can really be advantageous to choose the straight line depreciation method, okay, for financial reporting purposes, and choose the double declining balance method for tax reporting purposes. Within the scope of the US GAAP or IFRS principles, okay, there is some room to choose either method for different purposes. So you can ideally end up reaping the benefits of both these methods. Okay, now let's look at some specific cases that might arise once you've started depreciating an asset. One situation that might arise that there might be a change in the depreciation estimates you made at the beginning. It could either be a change in the lifetime of the asset or it could be a change in the residual value of the asset. Okay, let's look at an example on how to address these changes. Let's stick to the previous example we've been following. Okay, Joe has been using straight line depreciation for his reporting purposes. At the end of year 2, he estimates the total lifetime of the equipment is 6 years. And now the new residual value is $600. Recalculate the new depreciation expense. Originally, the equipment was supposed to be useful for only 4 years. Okay, but now the new useful life is 6 years. Also, the residual value, which used to be $200, is now $600. Because 2 years have already passed, okay, so at the end of 2 years, the net book value of the asset is $2,600 as per your books. Okay, because using the straight line method, which we saw earlier, okay, the depreciation expense is $1,200 per year. Okay, so we've depreciated for 2 years. Okay, the accumulated depreciation is $2,400 and the net book value is $2,600. Okay, we still have 4 more years to go and the new residual value is $600. Okay, So from 2,600, we have to reach a residual value of $600 through a period of 4 years. Okay, so the new depreciation expense every year is 2,600 minus 600, which is $2,000, divided by 4 years, which gives us $500 every year. Okay, so the new depreciation expense per year is $500. Okay, so for year 3, depreciation is $500. The accumulated depreciation we carry on as before. Okay, so 2,400 plus 500 is 2,900. Okay, and the new net book value is $2,100, which is 2,600 minus 500. Okay, we carry on the same process using $500 for the remaining 4 years. Okay, that would result in a final net book value at the end of year 6 for $600. So what other complex situations might arise as Joe is using his equipment over time? Sometimes he might want to sell the asset before its useful life has expired. Let's look at that with an example. Joe has been using straight line depreciation for his reporting purposes. He decides to sell his equipment at the end of year 2. He finds a buyer who pays him $3,000 in cash. Prepare journal entries to record the sale. Okay, so this is at the end of year 2 when he decides to sell his equipment for $3,000. The equipment was originally bought for $5,000. Okay, so he has depreciated for 2 years for $1,200 each, and the net book value at the end of year 2 is $2,600. Okay, whereas the sale price, okay, is $3,000. So on this particular sale, Joe makes a gain of $400. Let's look at how to make the journal entry for the sale. It's easier to understand the journal entry for the sale if we are able to readily refer to the journal entries that had been made until that point in time. Okay, so for example, when the equipment was bought, the journal entry that was made at that point in time was a debit to the PPE account for $5,000. Okay, and considering Joe paid cash, okay, a credit to the cash account for $5,000. Every year, Joe records a depreciation of $1,200. Okay, so he would debit a depreciation expense account for $1,200 and he would credit accumulated depreciation for $1,200. And he would repeat that also for the end of year 2. Now it is at this point that he decides to sell his equipment for $3,000. Anytime you sell an asset, the first thing you have to remember is to get rid of the PPE and accumulated depreciation accounts for that particular asset. Okay, so I'm going to reverse all my accumulated depreciation up until this point, and I'm also going to reverse the journal entry that I made in the PPE account when I purchased this asset. So when I bought the asset, I had debited my PPE account for $5,000. When I sell this asset, I'm going to credit my PPE account for $5,000. Okay, so the first step is to credit PPE by $5,000 during the sale of this asset. Okay, accumulated depreciation. So far I had credited this account by $2,400. Now I'm going to debit this accumulated depreciation account by $2,400 to reverse all the depreciation that has been accumulated so far. So I would debit my accumulated depreciation account by $2,400. By looking at these two entries together, we can see that an asset which had a net book value of $2,600 has been sold. It originally had a value of $5,000 and its value had dropped by $2,400 to reach a net book value of $2,600. At this point, it has been sold. Okay, that's the idea we get by looking at these two lines of the journal entry. Okay, but we also received cash of $3,000 on the sale, so I would debit my cash account by $3,000. We can see that now the sum of the debits does not balance with the credit value here. So the sum of debits is $5,400 and we've only credited $5,000. So the remaining $400 that has to be credited is credited on an account called gain on sale. Because the book value of the asset was only $2,600, but Joe received cash of $3,000 while selling this asset, he actually made a gain as per his books. So this gain is recorded as a credit in order to balance the overall journal entry. If Joe had realized a loss on sale of this asset, okay, he would have to record this loss on the debit side of the transaction. Let's look at another specific case where a particular asset might be impaired or might even be lost under certain circumstances. For example, Joe has been using straight line depreciation for his reporting purposes. He accidentally loses his equipment at the end of year 2. Prepare journal entries to record this loss. So the book value at the end of year 2 is the same as in the previous case, which is $2,600. When he loses his equipment, he'll have to record a loss of $2,600 in his books. The easiest way to visualize this journal entry is by assuming that you're actually selling this equipment for a net value of $0. So as in the previous case, you will have to reverse your PPE journal entry. So you would credit your PPE account by 5,000 and you will also reverse your accumulated depreciation. So you would debit your accumulated depreciation for a net total of $2,400. And the remaining $2,600, you would record it as a loss. Because it's a loss, you would have to show it on the debit side in order to balance the transaction. So technically, a loss is considered an expense, whereas a gain is considered a revenue. And together, they have a net effect on the stockholders' equity. That sums up depreciation. But what about natural resources? The depletion of natural resources is very similar to the depreciation of tangible assets. You would debit a depletion expense account, and you would credit an accumulated depletion account. Instead of depreciation, we just call it depletion. If you think about it, depletion is very similar to the units of production depreciation method, right? The more natural resources you extract from a particular asset, the more you're depleting it. And hence, it's similar to the units of production depreciation method. All other complications remain very similar to the depreciation examples we've seen so far. So we can move on to intangible assets now. Intangible assets can be broadly categorized into two: assets of definite life and assets of indefinite life. The ones which have a definite life are amortized over its useful life. Amortization is similar to depreciation. So for intangible assets, we use the term amortization. And we would amortize intangible assets of definite life over its useful life. But intangible assets which have an indefinite life, they are not amortized. But every year, they'll have to be assessed for impairment. What do I mean by assessed for impairment? You will have to check if the assets hold the same value as per what was recorded in the books earlier. If the asset had lost its value in some aspects, you will have to reduce the value of this asset in your books. Some examples of intangible assets with a definite life are patents, copyrights, certain computer software with estimated useful life, for example. Some examples of intangible assets with indefinite life are goodwill, trademarks, brand name, franchises, for example. From an accounting perspective, how can you differentiate whether you develop an intangible asset within your company or whether you chose to purchase this intangible asset from outside the company? If you're developing an intangible asset within the company, it means you're spending a lot on research and development. R&D expenses result in a lot more failures than successes. So from an accounting perspective, any type of research and development expenses are typically expensed in that period. They are not capitalized to be expensed in a future period unless a clear revenue generating asset has been developed. In this case, you can choose to capitalize it. On the other hand, if you purchase an intangible asset from outside the company, you're going to record this as an asset in your books and capitalize it. Now let's look into detail as to what goodwill refers to. We're going to understand this using an example. Let's say company A pays $2 million in cash to acquire all of company B's assets, which were appraised at a fair value of $700,000 and liabilities of company B were $200,000. Calculate the goodwill and prepare journal entries to show this acquisition. So company B's assets were appraised at $700,000 and their liabilities at $200,000. So the net valuation of company B is $700,000 minus $200,000, which is $500,000. But for this, company A pays $2 million in cash. So why would a company pay $2 million to buy another company which is valued at only $500,000? This $500,000 valuation is only considering the tangible assets of company B. Company A pays a premium, this $1.5 million in excess, to acquire company B. Okay, this excess $1.5 million that is paid to acquire company B is paid for its intangible assets. This could be for the brand name or other trademarks which company B possesses. Okay, and this excess $1.5 million is known as goodwill. So how do you do the journal entry for goodwill? Okay, when you buy company B's assets, okay, the assets were valued at $700,000. They now become your assets. Okay, so you would debit your assets, whatever they might be, inventory or accounts receivable or cash, whatever they are, you would debit all the assets by $700,000 and you would also credit your liabilities by $200,000. Because you're paying cash of $2 million to buy company B, you would credit your cash account by $2 million. Okay. Finally, you would debit your goodwill account, which is an asset, for $1.5 million in order to balance the transaction. This brings us to the end of this session on accounting for long-term assets. In the next session, we're going to look at how to account for liabilities. And in the session after that, we're going to look at how to account for bonds in particular. Thank you for watching. See you in the next one. Cheers.